Hello, and welcome to the HFA Webinar, Top Hedge Fund Strategies. I'm Mitch Ackles, the Global President of the HFA. Before we get started, I'd like to thank our event sponsor and HFA thought leader, Citrin Cooperman. The Hedge Fund Association is an international nonprofit industry trade and nonpartisan lobbying organization devoted to advancing transparency, development, and trust in alternative investments. Membership in the HFA includes the entire ecosystem of executives focused on alternative investments, including managers, allocators, and service providers. If you are not already an HFA member, please consider joining today at hedgefundassoc.org. Now it's my pleasure to introduce HFA Global Board Member, New York Regional Chapter Director, today's moderator, and Citrin Cooperman Partner and Financial Services Practice Leader, Alexander Reyes. Alex, please take it away.
Thank you, Mitch, and welcome everyone. As Mitch said, I'm Alex Reyes, and it's a pleasure for Citrin Cooperman to once again team up with HFA for this annual program. This is our fourth year hosting this event, and we've put together an incredible panel of allocators today that will share insight and perspective on hedge fund strategies and how COVID-19 has impacted the hedge fund community. After our panel, we'll open it up to audience questions, so please feel free to submit any questions during the program using Zoom. It's now my honor to introduce our outstanding panelists. First, Christie Hamilton, Head of Investments with Children's Health. Tiffany McGhee, CEO and co-CIO, Institutional Investment with Momentum Advisors. Hernan van Waveren, Founder and Managing Partner with Oceanside Advisors. Thank you to the speakers for agreeing to join. And now let's get started. Why don't we start with a question for all of the panelists? Obviously, COVID-19 has impacted many hedge funds, some more than others, depending on strategy. How has COVID-19 impacted your investment portfolios? What's working, and have you made any adjustments? I think maybe we start with you, Tiffany.
Sure. Thanks, Alex. And thanks, Mitch. So, we're in this really, really crazy time, and I feel like things are changing by the day even. And so with our team at Momentum, of course, we're always looking at portfolios, and, we had that crazy kind of downturn in February, and then of course, March, I kind of think about it like all heck broke loose, but what really did well for us was our hedge investments. And in particularly our liquid alt strategies, developed markets, some long short equity strategies. And those were really kind of buoys for us. And again, I don't ever kind of like to give credit to one asset class or one particular strategy, because those kind of fall in and out of favor. So I think everything really starts from a really sound asset allocation, right? And that's what we always do with our clients. And we did, we were pretty kind of proud of the asset allocation and portfolios that we constructed. And really, incorporated these hedge strategies because they worked. These were the strongest performers in our portfolio. So to kind of go back to clients, we manage portfolios for foundations and endowments primarily. And to be able to have this conversation with clients and say, hey, these are, yes, you're looking at the news and you're seeing that the market is down, but we do have some good news. This portion of your portfolio is doing very, very well. Those were not bad conversations to have. So.
Yeah, and
thank you, Tiffany.
Alex, if I can take it from there. Hi all.
Same question, please. Yeah.
Yes, just to piggyback a little bit on what Tiffany was saying, for our standpoint, now it's time to be tactical, and the market is asking us to be opportunistic. It is not time to be on the sidelines, and for me, there are huge opportunities out there to invest. So what I mean by this, we've had actually now 5 very interesting market opportunities in the last practically decade, which for avid investors have paid really well. And actually hedge funds have successfully navigated these periods of volatility. And what was Tiffany saying is, like, if you can see the downside capture of hedge funds for these, let's say, I would say, what is it, 5, let's say, market corrections, hedge funds have actually only captured 35% of that downside. So for the hedge fund community participating today, I see 3 years of interest. Developed markets credit, that I see it to continue to recuperate as treasury rates seem to point to negative or zero rates. Long short equities, as it continues basically to outperform in this volatile environment. And specifically, and it's more for me, it's emerging markets debt that I'll use, let's say, and I consider that it's very, very opportunistic. And I'll use a little bit what big banks say is be cautiously opportunistic. But I think that it's an area one should explore at this point in time.
Thank you, Hernan. And Christie, same question.
Certainly. So, I mean, kind of building on what the group has said, hedge funds have gotten such a bad rap for the past probably 10 years. And so it was nice to have that downside protection going into, or I guess as we ended March and even into April a bit, and that they proved that they can do what they're supposed to do, particularly on the long short side. And even, a lot of our absolute return guys held up pretty well as well. And I think the biggest change in all of this is we are no longer in the 15th inning of the economic expansion. And there's finally some distress to focus on. I mean, granted, we're kind of in phase 1 of the distress cycle, but there'll be quite a few opportunities coming through. And I think hedge funds are well positioned to take advantage of that, particularly on the credit side.
Perfect. Thank you, Christie. I guess shifting back to you, Tiffany, from a client sentiment perspective, how has client sentiment around hedge fund strategies changed during this time?
Yeah, I mean, Christie definitely touched on it. Hedge funds have definitely kind of gotten a bad rep. I would clearly say in the past 10 years, and maybe a little bit longer, headlines don't really help sometimes. And, I like to think about things really from a practical perspective. Our clients, even though they are responsible for investment portfolios of hundreds and hundreds of millions of dollars, aren't necessarily investment people. And so part of our job is to, be able to have conversations with them when, they are watching the news, and when we know and doing maybe, some more surface research, and being able to kind of help them navigate through those fears and through those headlines. So that's always kind of like a bit of a challenge, because we want, at the end of the day, I say a lot that we can construct the best portfolio ever, but if our clients aren't comfortable with that, we're not going to do it, right? And they do hire us for a reason. So this is actually, in this particular time, it really is like a stress test for a lot of these portfolios. And, we really believe it's a stock picker's environment, and the way to do that, one great way to take advantage of individual names really is in the hedge fund arena. So again, these conversations that we were able to have with clients are, I think it made us look really, really smart, to say, hey, right, we've constructed this portfolio for you. We asked you about, we brought, hedge investments to you. We had conversations. Thank you for putting your trust in us. These are the portfolios. These are the names and the strategies that are up in your portfolio, and everything is working together.
No, that's fantastic. And I guess along those lines, Hernan, what would you say is the current challenge or opportunity that hedge funds face today when offering investment alternatives?
Alex, interesting question. I actually also echo a little bit what Tiffany said. There has been a lot of market commentary focus on this market downside. Now, the conversation for hedge funds is totally different, and hedge funds have performed amazingly well. So for me, there are two areas that I see of opportunity, of interest. One is, we already discussed it, that is how hedge funds have successfully captured, let's say this downside in this COVID-19 situation. Additionally, from that, if we can see historically, let's say these last couple of years, hedge funds have not been performing as expected. Now, historically, we can see that hedge funds tend to regain their market valuations after 3 years on average. For the equity markets, in average, it takes actually 6 years. So now, for me, let's say I think that is a positive opportunity for people to be in front of clients, explain why they are investing in this asset class, why it pays off when markets are volatile. So that is a huge opportunity to stress to clients. Now, what are the challenges? As I see it, is many hedge funds have carried a lot of leverage in their portfolio, and the structuring is a little bit of an issue. Let's say everybody knows and has read that hedge funds have, let's say, or some hedge funds have really had a lot of leverage in their portfolios, which has actually created a lot of volatility in the market, or was a causer of a lot of volatility in the market in this downturn. And the other thing that worries me a little bit, and it's a challenge, is if we analyze the hedge fund industry as a whole, 70% of their long portfolio is allocated in their top 10 positions. This is actually up from 55% that it was in 2005. So to put it a little bit into context, if we see the S&P 500, the largest 10 companies only account for 25%. So there's a huge concentration in, let's say, in hedge fund positioning or portfolio structuring, in average in the hedge fund community. So as to summarize a little bit, I see hedge funds as a great opportunity to navigate volatile markets, but be careful, let's say clients, be careful managers in how you select and how you diversify hedge funds or your portfolio in the long
run. And thank you, Hernan. And I think when we think about the feedback, Tiffany, you and Hernan shared, I think this next section here on due diligence will be really valuable to some of the fund managers. So I'm going to shift to you, Christie, and we're going to dive into a couple of due diligence questions. What do you look for most before starting the due diligence process on a new hedge fund manager, and what might be some red flags that could prevent you from considering an allocation?
I mean, with us, kind of our process, we're looking at the 4 Ps, so people, process, philosophy, and performance. So that's kind of the base of any due diligence process. But one of the big things that we're looking at in terms of, or even evaluating for the portfolio, is actually the role in the portfolio. So the role that the position would play, building on Tiffany's to asset allocation and the importance of kind of every position being in there for a reason. And then opportunity is incredibly important as well. So those two things together are the basis. So the opportunity set and the role in the portfolio, because obviously, if those two things don't match up with what we're looking for, then we don't want to waste anybody's time. Big red flags, obviously, we're concerned about leverage or strategies that take on too much leverage relative to peers. I mean, obviously, some strategies kind of focus on that, but in terms of other red flags, we're also looking at the team. We look at your background. We're obviously not going to talk to your 3rd grade teacher, but we want to know that we're partnered with the best people and that we're partnered with people that we can trust. So again, I think kind of at the onset, the opportunity set, the role in the portfolio, and just the people are the biggest keys.
Perfect. And thank you, Christie. And I guess, Tiffany, a similar due diligence question, except how has the pandemic changed your due diligence process?
Yeah, I mean, so I don't know that it's necessarily changed our due diligence process. I mean, you know, similar to Christie, we're looking at both quantitative and qualitative, you know, information when we're evaluating managers. You know, of course, you know, usually first we're looking at the numbers. But I think in this current environment, there are kind of these two kind of like pools. And so, you know, when you look at hedge funds, there's been a lot of consolidation, you know, in probably over like the past 10 to 12 years. And so when you look at some of these funds, I want to see how you're doing in a down market, right? And we just really haven't had an opportunity to see all heck break loose and see how you kind of roll, right? So this is kind of like that opportunity for us to see, and not just how you're performing in terms of your numbers, but how is your, you know, how is your team performing? You know, how are you guys kind of fearing the storm? The other piece is that there are, you know, newer hedge funds. And so we're looking at those and we're saying, you know, we are not opposed to seeding funds. We do have to feel very, very comfortable before we do that. But, you know, we've had some names come to us with paper portfolios, and we're looking at that, and, you know, now they're kind of up and running, and this is kind of like their time to shine. And a lot of them are doing very, very well. So we're looking at that. And so maybe our due diligence process would have been a lot longer. Now we are, we're getting a chance to see them perform in an extremely volatile market. And so that time might be a little bit short.
Perfect. Thank you, Tiffany. And I guess I want to shift to Hernan. You talked a little bit about this earlier, but maybe you can expand on it. What hedge fund strategy do you see on the rise that would broaden diversification and increase allocation from your targeted investors?
Thank you, Alex. Can I take the whole time of the call to answer this question? No, so actually, exactly. No, so actually, I believe that the one thing that COVID has taught us is that we're all connected. This pandemic has changed many things to all of us here participating actually in this call today. We can't avoid any more social and economical issues that are happening local and actually globally. I'm a believer and that like we should use capital as an instrument for change. As a passionate surfer, I can tell you I love to apply this mantra on my everyday life: catch the current, make the wave. So in my perspective, and for my targeted investment, that means we're looking for more ESG impact investment alternatives that are definitely going to be the bigger voice, I believe, in the coming years. So the idea of just bucketing investments, I believe, is totally changing. We can't avoid any more social, economical issues. And let's say, just to put it into context, we all now need masks. We can't hug our friend if he has actually lost a loved one. So this for me is a local global challenge that will shape how we deploy capital like in the coming futures, Alex.
Thank you. That's a great response to a difficult question. Just shifting to a different subject, Christie, I know we know you're pretty active on Twitter, and you recently asked your 20,000 plus Twitter followers what they are most fearful about right now. And curious, what did they say? How would you answer that question?
Yeah, it's interesting. first of all, anybody who's listening who follows me on Twitter, thank you. I just greatly appreciate your feedback and was really impressed by a lot of people's answers. But I would say the biggest worries, because I specifically asked fixed income people, I feel like on average, they're a little bit more skeptical than those of us who are more equity oriented. And I would say that they're really concerned about businesses staying afloat. They're absolutely concerned about what's going on in real estate right now, about being able to, about rent collections, about retail. They're worried about the possibility of negative rates. They're worried about what's going, this kind of disconnect between equity markets and fixed income markets right now. There were a lot of concerns expressed, and I welcome anybody, please go out there and look. I think that there were, I believe, over 100 answers. And I know a lot of people me as well. But just overall, the health of the economy, the ability to restart, I think that we are probably, that they believe, many of the people who responded believe that we are probably a little bit more positive on the restart versus what's actually going to happen. Getting 30 million people back to work is going to be much harder in their opinion. And I think overall, just a much kind of bearish stance that that wasn't necessarily surprising, but that was, you know, kind of a little scary and a little, you know, very interesting to read.
Thank you, Christie. And I guess Tiffany and Hernan, I mean, what keeps you guys up at night as you think about what's going on now in the economy?
Yeah, me. So I can answer that. You know, I think that you know, I'm not necessarily being kept up at night. I think when this all first started, again, these are really unprecedented times. We really don't have a lot to go on to kind of go back and look at a time in history where things were quite like this. And so, you know, I feel like in the beginning, it felt kind of like a snow day, you know, for those of us on the East Coast, it felt like a snow day. But then we quickly, you know, understood that the world had changed. And so really kind of following up on what Hernan was saying, the world, you know, the social and economic divide is very evident right now. And at our firm, we really do like to, you know, we pay attention to our values. We, you know, we weave ESG into our due diligence process. That's really what it's supposed to be. We're asking these questions about managers. And I think, you know, years ago, there was a focus on the E in the ESG. And we were always just as equally focused on the S and the G. And now we're seeing that, you know, we're seeing some of these companies paying attention to how they're reacting to this pandemic in terms of how they're treating their employees, how they're treating their customers. And it's going to be interesting. What we're seeing is that the names, you know, the individual companies that are they're reacting, that are handling it a little bit better, are actually doing better. And so it's, you know, while we weave ESG into our due diligence process, sometimes with hedge strategies, it's a little bit harder to do, even though we're still looking at that, because sometimes they may have like a quant model and it's not really about, you know, necessarily the people, but it's more about an algorithm. But it's going to be interesting to see how this all shakes out, how, you know, individual names will contribute or detract from portfolios, and kind of looking at how they're responsibly handling the current pandemic.
Thank you, Tiffany, for sharing that. And Nan, do you have any thoughts on that? Things that might keep you up at night that you might be fearful of?
My main concern is no matter where you live, let's say everybody's wondering what's the new normal will be. We are definitely not going back to that old normal. So the main question that I try to answer both personally and professionally is, so where's the new normal? Let's say where's gonna, let's say what is going to change and what is going to evolve, so as to be opportunistically positioned to take advantage of that new normal.
Thank you. Thank you.
And if I can jump in real fast on this as well.
Yeah.
Kind of to Hernan's point, what are the secondary effects that we're not thinking about? That is actually something that's been keeping me up at night. I mean, just as everything's been shut down, how that affects tax income for municipals, how that's going to affect, the kind of broader government and how, incomes are distributed, just kind of knock-on effects and even tertiary effects of that are going to be felt somehow, but we don't really know how yet. And to think through that is actually, quite the exercise. And I've definitely been thinking about it at 2 a.m. before.
Yeah, absolutely. I think it's there's so much uncertainty right now that I think many would agree with you that that's creating some stress and anxiety. I guess I want to shift to a slightly different topic here with you, Tiffany. For years we've been hearing about mandates on minority and women-owned funds. Share your thoughts on this particular segment of the industry, and whether it's gained traction, and what advice you would have for these managers.
Yeah, so we tend to think about, I think when these discussions are had about diverse owned asset managers, they tend to be very separate conversations. And so, at our firm, we've been saying for quite some time that this is an ESG conversation, right? So we can't talk about having women on the board of organizations, of companies, without talking about, ownership. And so we've been having that discussion for some time now. And, before this, our kind of current normal happened, we were starting to see kind of like this shift that ESG and diversity were being talked about in the same room. And we were really, really happy to see that. So first, it's just one conversation, right? And so, one of the things we look at, and we could probably talk about this for the rest of the day, but, we've been very passionate. We are a diverse-owned firm, one of the only diverse-owned investment advisory firms with an institutional focus that we know of. And so we feel a huge sense of responsibility. We've read the research, we understand the research on the case of diversity, and we also read the research on the case for bias and allocating to diverse-owned managers. And so we don't necessarily at our firm have to have a diverse asset manager program, because we don't really have, we honestly don't have that type of bias. So we're looking at everyone through a very open lens. But we're really happy to report that in the first quarter of 2020, our top performing funds were diverse-owned managers. And that's something that we are saying, on multiple panels. We are, shouting that out through like the rafters. That's a story that needs to be told. This shift in the conversation to allocating to diverse managers, not because it's a favor to someone, but because number one, it's the right thing to do. Right. Ultimately, our goal and as allocators and individuals who manage entire portfolios and responsible for asset allocation, our goal is to generate alpha. And much of the research shows that these managers, do not underperform. As a matter of fact, in many cases, they outperform. And the reasons why we can talk about in another webinar. But I'm also happy to say that those managers that are outperforming, those diverse managers, we've actually doubled down on them. So we've allocated more. And I think part of their success is the type of strategy, right? So one of them actually is a hedge strategy. But I think one of the things that that we need to be aware of as we had this conversation about our new normal and the economic divide, and as we kind of emerge from this, reallocating capital really in a socially responsible way. Again, diverse owned asset managers is a part of that. And I think that, you know, some of them, maybe they have strategies that we're, you know, really not in favor right now. I think that some of them are at risk for, you know, larger allocators to take money away from them. And I'm starting to kind of talk to, you know, pensions and foundations who, whose, you know, values really include allocating to diverse managers, and really identifying who's doubling down and who is, you know, and who is a little bit concerned about this. So it's an ongoing discussion, but I think if we start all of our discussions around kind of alpha, I think, you know, all of that kind of shakes out.
Thank you, Tiffany. You know, Hernan, you know, just shifting to more, you know, economics and politics a little bit. I mean, what are the main economic and political concerns after this COVID backdrop?
So Alex, more on a political and economic concern is governments are being each day bigger and bigger. So we can see that the public sector is taking massive amount of debt. So let's say, and actually we don't know how we, the population, will actually pay or sustain these expenditures for the long run. So that is something that is starting to create a little bit of noise. We are just months away of a key presidential election that, from my standpoint, will define if we maintain or we change our international relationships picture. So let's say one of the main catalyst or main, I would say, question marks that I see for the next coming, let's say the next coming years is US and China confrontation. This is and should be a concern on how we think the investment decisions. And so, and I would end lastly, let's say, as a Latin American homegrown, an advocate for family offices in the region, I am really worried, really worried on how these economies will survive this massive economical crisis, just given by their lack of monetary firepower. So it's, this COVID-19 has definitely been devastating for those economies. So I would say those are the things that most worry me for these next couple of months to 2 years.
Thank you, Hernan. That was perfect. I want to shift to Christie. You know, on a topic that, you know, seems to go up and down in terms of activity. But what are your thoughts on crypto hedge funds? Do you think they're being embraced by institutional investors?
I mean, it's so difficult because it's a relatively new strategy to invest in, and we don't necessarily understand the drivers of that market. I know that a lot of times the pricing rises and falls, particularly with Bitcoin, with ransomware viruses. But other than that, it's us still trying to get our heads wrapped around the impacts and the key drivers of that segment of the market. I know a lot of groups are seeding it, but most of them are looking at it more as venture capital versus you know, as part of a traditional hedge fund allocation. That's to get information, that's to start, you know, thinking about it, because one thing about us is we're obviously going to go where the opportunity lies. We're in the business of making money. So if there's money to be made there, obviously something we all would be interested in, but just at this point, I can't necessarily say that I understand how the marketplace functions. And so I don't necessarily feel comfortable going to an investment committee, or, you know, I'm sure others aren't really comfortable going to clients and saying, invest in this, without understanding how the marketplace actually works. I mean, we're going to need a decade of information before it becomes a real, you know, part of our portfolios.
Thank you, Christie. I mean, Tiffany, do you have any involvement with any crypto funds? Any thoughts on this question?
Yeah, so I'm actually really happy to hear Christie's response to that. You know, again, our clients are for the most part institutional, and I think Christie's spot on. There's a lack of information about, you know, drivers in that market, and really just to kind of take it from a basic perspective. You know, if you've ever, you know, listened to a panel or you know, anything or read anything on crypto, it's not very clear, you know? And so, you know, when at our firm, before we get into anything, you know, we want to really understand the market very, very well. We want to feel comfortable with it before we even bring it to our clients. We want to make sure, you know, we're very thoughtful about those things, about the ideas that we bring to clients. We want to make sure we have answered all of our questions. We've answered all potential questions for clients, and we feel very, very comfortable with it. And we're just not there on crypto. I mean, I think we've kind of definitely, you know, sought out lots of information, and we feel like we know a lot more than we did, say, even like 3 years ago. But, you know, there is some volatility there. You know, and we just, in our view, haven't, you know, really seen the data on the drivers of the market, right? And I think Christie's absolutely right. We tend to see investments from more of like a VC perspective and not the actual, you know, like industry function. So we're still watching it. I mean, yes, we too are in the business of making money. But we want to, you know, make those decisions in a very smart way. We're, you know, number one on our list is to minimize risk. We believe that when we're constructing a portfolio, we've got a risk budget and a fee budget, right? And we will spend those two accordingly. We're not afraid to spend those, but we're very smart about how we spend risk and how we spend our fees. So the verdict is still out on that. We're still kind of like, you know, watching that, and then just kind of gathering as much information as we can.
Thank you.
Yeah, Alex, and I'll piggyback a little bit on what Tiffany and Christie said with regards to crypto, because it's definitely something that clients normally ask and normally want to be or want to participate. And I agree 100%. There's a lot of unknowns. So if you're gonna invest, and this is my personal recommendation, is like if you're gonna invest in the sector or in the area, invest with an experienced and well-versed manager, you know, like, so it's important to use specifically hedge funds if you're investing in the crypto arena, and do it with somebody that has shown, let's say, positive performance, has shown that they are well-versed in let's say, in the area, and that can produce high returns in the future.
Perfect. Thank you. I guess this next question really is going to go to all the panelists before we go into the audience Q&A. So I'll start at the top. Tiffany, how can hedge funds increase their leadership voice right now to influence the mind share of investors?
Yeah, so I'll give the Hedge Fund Association a plug. I mean, I think, you know, this is an organization that is an advocate for hedge strategies. So number one, you know, join this organization. I would say you know, I think that there's safety in numbers and there's advocacy in numbers. But I think, you know, on a very basic level, these are the strategies that are doing very well right now. I mean, period. You know, there has never been, you know, fund managers can make their case, you know, and be very, very intelligent in making their case. But at the end of the day, if you're able to perform in a market like this, that says everything. And so I think that, you know, they should be very, very vocal about that. And again, just kind of thinking back to some of the funds that we're in due diligence with, you know, you start to kind of watch, you know, with all of our strategies that we're in due diligence with very, very closely, again, looking at how they're performing in a down market. And with, in particularly, you know, the hedge strategies, I literally went back to all of them and said, hey, I need like weekly updates, or, you know, I need updates, not quarterly updates clearly, but I need more communication. I want to see, you know, what you guys are doing on at least a weekly, if not like a monthly basis. So, and again, what that's done is it's probably going to shorten the due diligence process for us, just, you know, a little bit. So I think kind of, you know, telling that tale is very important. If you're able to say, look, you know, our portfolio was stress tested, you know, in this current pandemic when the world changed, and we were able to make money in that environment. I think that speaks volumes.
Yeah, thank you, Tiffany. And now, same question.
Thank you, Alex. There's so many things to actually say, but I'll end up with this, that it's something that not like wakes me up every single day, and I mention it to me personally. Use capital as an instrument for change. So with $3 trillion in asset under management that the hedge fund industry has, they should be advocates for the people and stressed on social and economic changes. So to end more in a personal way, I would say, I will share my ethos is believe you can create a difference, believe in the power, let's say in your power and your reach, believe in maintaining successful return-driven investments, and believe in the shared commitment to create change. So that is how hedge funds can increase their leadership, definitely, for the next coming lovely future we have up ahead of us.
Yeah, thank you, Nana. Christie?
I would say watch out for, you know, your positioning. Obviously, fund flows are going to be important just across the marketplace. So, you know, watch out for crowded trades. Don't get into the pitfalls that we've seen hedge funds experience in the past. Really just stick to your knitting and keep doing what you're doing. And to Tiffany's point, communication is absolutely key with us. Keep us in the loop, and particularly for your LP or for any hedge fund managers, LPs out there, communicate with us, let us know. For the most part, we're evaluating you right now. And again, this is something that Tiffany's kind of mentioned. We're evaluating you versus our expectations, not necessarily versus, you know, some arbitrary benchmark like the S&P. So, you know, just because you have a down period doesn't mean that it's necessarily a bad thing if that's what we're expecting. But you have to keep us in the loop, and you have to explain that to us and explain what you're doing and how you're positioned. So transparency, I think, is going to be a huge deal as well.
Yes, and communicate also from big investors to small investors. Let's say, and I'm speaking more for family offices, that sometimes it's the communication flows more to their pension funds, to the IRAs, but let's say sometimes for family offices, which maybe the tickets are not that substantial for the assets under management they have. It is key to communicate to all of your investors and communicate constantly. Because let's say one of the biggest, let's say, or my point is the biggest important thing to do is for clients to think that they are participating, let's say, on the communication and participating on the investments you're doing. So be active, communicate, be on top of clients. That is definitely key.
Perfect. I think we're a little past the initial session. I think we want to just shift right now to some of the audience Q&A. I have a couple of questions that I will mention now, and then it's really open to any of the panelists. So the first one is distressed and credit managers all seem to be saying the same thing, that the opportunity set is the best in a generation. What are your thoughts on the distressed credit space?
I'll go ahead and jump in.
Okay.
Oh, this is a space that we're definitely looking at right now. It's obviously interesting. It's been a while since we've had a distress cycle. Although hedge funds specifically, I think, are going to struggle relative to more drawdown funds, they're definitely going to be key in these first two phases. So you have kind of the first phase, the liquid phase, which we saw in March, could mostly be over just given, what the expectation of the Fed now, but particularly in the rescue financing and the structured credit part, more phase two, kind of the no man's land. It does seem to be one of the best opportunity sets we've obviously seen in a while, and actually even seems larger than what everybody is kind of raising and opening their funds for. So at least from our part, that's definitely something we're evaluating and something we're incredibly interested in.
Perfect.
Yeah, we love it. We love it as well, Alex. Let's say we definitely think that there's a big opportunity. Let's say in the distress space. It is important to do it again with managers that are, let's say, that have the experience, that are in the field. So I definitely believe, let's say, if you start, there's a lot of things that, let's say, don't add value, but there's a lot of value out there that can be created in the distress credit space, definitely.
Tiffany, I don't know if you had any thoughts on this particular question.
Honestly, I'm actually with both Christie and Hernan. I mean, it's certainly an interesting space. We're definitely looking at it and following it. It's again, this pandemic has kind of created some clear opportunities, but I think manager selection is particularly important. So yeah, we're definitely interested.
Just a couple of other questions. One, how are you estimating impacts to real estate assets like MBS, CMBS, CDOs, et cetera?
So if you want, I can give it a shot. It's not an area that we invest very actively in. Having said that, I consider there's a huge dislocation between what is happening in, let's say, in the liquid markets and the real economy. So I'm a believer that we haven't yet understood the impact of this crisis in the real economy. So for my point of view, what I've been seeing more in the real estate space, I think, and I believe this will need or will have another leg down. Once everything opens up and we start realizing that tenants can't pay rent, then landlords will need to decrease leases. That will definitely impact that space considerably.
Thank you.
Yeah, and something that most of us are watching closely. On Hernan's point.
Yeah, and I'll just say, we're based in New York, and I think actually I got several of these questions, last week. I think that we're really in this time where a lot of us were used to working from home, and a lot of companies weren't doing that. But now we all have to work from home, and I really believe some companies are now thinking about, well, when we go back to whatever normal is, do we really need that office space? Do we really need 30, 40, 50 offices? Or can we really have our folks work from home? Because now they're doing it, and it's either working or it's not working. But I think for a lot of companies, it's working. So I was having this conversation the other day about what does that mean for real estate, especially in a place like New York where there's so much of it. How's that going to change?
Okay. Another question here on hedge funds. Are hedge funds sufficiently regulated? That's always an interesting question.
Define sufficiently. I mean, so I'll just go ahead and take this one. I mean, so listen, they're not regulated in the way that a 40 Act mutual fund is. But I think that, and again, like I really kind of see, I really get excited about hedge funds. I really, not to take anything away from any other fund managers, but, some of the best hedge funds have, really, really smart people running the portfolios. And they're not always disclosing everything. I think, and legally they're not necessarily required to. But I think that as an investor, you have to get comfortable with the level of transparency of a particular manager. And I think from a manager's perspective, they're allowed to give a little. I mean, they don't have to give away the secret sauce, but this is the industry that they're in. They know what they got into. Again, hedge funds have kind of gotten a bad rap because of certain people that weren't doing what they were supposed to do. So I think it's kind of like a trust exercise between managers and between investors. And I think, for investors, you have to do your due diligence, and I mean real due diligence, because we're not dealing with the 40 Act mutual fund where so much is regulated that it's really kind of, where if things fall through the cracks, the SEC is able to kind of, see that. So, little things like, what kind of accountant they're using, right? I guess that's a plug for Citrin Cooperman. But, all of those things, background checks. We do background checks on our managers. You're allowed to do that. And, where do they work before, and before that. So I think a lot of the onus is on investors. But you can't, you've got to take that responsibility on yourself.
And that's true across the board with alternatives. Due diligence is just so important. I'm glad that Tiffany used the buzzword. I think that we talk about regulation and stuff, but it's a false sense of security in that there are so many things that kind of our regulation agencies can't necessarily cover. And so it is on us to go and do that hard work. It is on us to go in and read all of the documents and really understand the manager and the team and what they're doing, and not to invest because they've had good performance historically.
Yeah, and also, let's say there has been a lot of talk that hedge funds actually have been the ones that absorbed a lot of the off-balance sheet assets that many banks needed to get rid of, let's say after 2008 crisis, and that they haven't, and it was a way of avoiding regulation. So let's say maybe I understand a little bit where the question goes, but let's say on my standpoint, should they be more regulated? Maybe they should, but let's say, but I consider that but they have been performing really well. So more regulation doesn't mean that they will be performing better. So let's say I'm a still believer, and I still love hedge funds. So I would leave it as is.
And I guess one last question, and I think Christie, you might appreciate this. In your manager due diligence process, does your activity on social media have an impact?
So I've answered this, and my response is like yes and no, right? I mean, because we obviously don't want people who are spending their entire life on social media instead of managing a portfolio, but I don't necessarily hold somebody's social media account against them. I know some people get kind of up in arms about different groups and maybe the political views of a PM, or their kind of more macro views. And, I include that in due diligence when we're looking at them, obviously. I mean, it's part of their philosophy and in some instances, even their process, but I don't necessarily hold it against them. I say that unless they're out there kind of being abusive to people, and then that goes back to the wanting to partner with the best people. So again, typically not a deterrent because most groups aren't doing that. But I don't necessarily think we should be afraid of people with differing views or with views that we don't necessarily agree with. And I don't think we should hold that against groups that we invest with.
Can I just jump in for 2 seconds? I absolutely agree with Christie, and I'm thinking of one manager in particular that we hadn't started the process with, but we were considering starting the due diligence process with, not a hedge fund manager, by the way. And again, I'm definitely fine with anyone having different views than than we do, or a firm. But at the end of the day, you know, my clients are all different. And this one particular manager, you know, what I don't want for you to do is to be one way in your professional life, or to be one way as you're, you know, talking to us for the due diligence process, and then be a completely different way and on social media, and be just not the kind of person I would ever invest my money with, especially not my client's money. And I won't go into too much detail, but, you know, all of that stuff is public information, you know. And again, at the end of the day, you know, we have discretion over client portfolios, but when it comes to, in particular, alternative investments, we have those conversations with clients. They've got to sign subscription documents, right? So we have those conversations. And so if you're out there behaving in a certain way, that's not a good conversation for me to have with my client, because it's out there for them to see. So just be mindful of that. It doesn't happen a lot. But again, there's one particular manager, and I was like, oh, yeah, we're not going to, definitely not move forward in that direction.
So be additive to the conversation. Don't be a jerk.
Yeah.
Right.
No jerk policy.
the no jerk rule, and keep the food posts or the what you're eating for dinner posts to a minimum.
Right.
For whatever reason that bothers people.
I love the food posts, by the way. I'm fine with those.
I do too, but for some reason, yeah, people seem to have a negative view on that on average.
Wow.
I love it. I love it.
Perfect. Well, I think we're at the end of the webinar. I want to just take this opportunity to thank you, really this wonderful panel. We really appreciate your insight and perspective, particularly in the midst of so much uncertainty. I'm confident that, you know, we'll get out of this difficult time stronger in the long term. I also want to thank all of the attendees for attending today's HFA webinar. Please look out for future HFA and Citrin Cooperman events, and please stay safe. Thank you.
Yes, thank you, everyone.
Thanks, guys.
Thank you.